If you're confused about the difference between index funds, ETFs, mutual funds, and hedge funds, you're not alone. And that confusion is costing you money. Here's a shocking truth. Last year, banks made over $100 billion in credit card fees, mostly from people who thought they were playing it safe. These two pieces of plastic work in completely different ways, and understanding the difference could save you thousands of dollars or cost you thousands, depending on how you use them. Both cards can help you or hurt you. It all depends on how you use them and whether you understand what you're actually doing. So, what the hell is a fund anyway? Before we dive into the different types, you need to understand what a fund actually is. Think of it like this. You and your friends want to throw a party, but nobody wants to handle buying everything alone. So you all throw money into a pot. Someone gets the drinks, someone gets the food, someone handles music. That's exactly what an investment fund is. A bunch of people pool their money together, and instead of buying party supplies, you're buying stocks, bonds, and other investments. The key difference between fund types, who's making the decisions about what to buy, and how much they're charging you for those decisions. What about index funds? Index funds are the boring, reliable friend who shows up on time and never causes drama. An index fund doesn't try to be smart or pick winners. It just copies a list of companies like the S&P 500 and buys a tiny piece of each one. Think of the S&P 500 like a popularity contest of the 500 biggest US companies: Apple, Microsoft, Google, all the heavy hitters. When you buy an S&P 500 index fund, you own a microscopic piece of all 500 companies. Here's why this is brilliant. If one company crashes, you've got 499 others to cushion the blow. If the overall economy grows, you grow with it. The best part, index funds are cheap as hell. We're talking 0.03% to 0.20% annual fees. On a $10,000 investment, that's $3 to $20 per year. You probably spend more on coffee in a week. But here's the catch nobody tells you. You can't trade index funds like stocks. You place your order, and it gets processed once per day after the market closes. No real-time trading, no timing the market. For most people, that's actually perfect because it prevents you from doing stupid things like panic selling during crashes. But what about mutual funds? Mutual funds are like index funds' expensive cousin who thinks they're smarter than everyone else. The big difference, mutual funds have active managers who think they can beat the market by picking winning stocks. Here's where it gets expensive. Instead of 0.03% fees, you're looking at 0.5% to 1.5% annually. On that same $10,000 investment, you're now paying $50 to $150 per year instead of $3 to $20. That might not sound like much, but let's do the math. Over 30 years, the difference between 0.1% fees and 1% fees on a $10,000 investment is about $18,000. You literally pay an extra $18,000 for someone to actively manage your money. And here's the kicker. Most actively managed mutual funds don't beat index funds over the long term. You're paying extra for worse performance. So why do people buy them? Because financial advisors make more money selling them to you. The fund companies pay advisors higher commissions for pushing mutual funds over index funds. It's not about what's best for you, it's about what makes them the most money. So what's the deal with ETFs? ETFs are like the cool hybrid that took the best parts of index funds and stocks and mashed them together. ETF stands for Exchange Traded Fund. Unlike index funds that only trade once per day, ETFs trade all day long, just like individual stocks. This means you can buy and sell them anytime the market is open, watch their price change in real time, and actually time your purchases if you want. Most ETFs track indexes just like index funds, so you get the same diversification and low fees, usually 0.03% to 0.75% annually. The main advantage, flexibility. If you want to buy the dip during a market crash, you can do it instantly with an ETF. With an index fund, you have to wait until the end of the day. The main disadvantage, you might be tempted to trade too much. The easier it is to buy and sell, the more likely you are to make emotional decisions that hurt your returns. For most long-term investors, the difference between index funds and ETFs doesn't really matter. Pick whichever one has lower fees and stick with it. What about hedge funds? Hedge funds are the exclusive club you probably can't join, and honestly, you probably don't want to. Hedge funds are only for accredited investors, basically rich people who can afford to lose large amounts of money. We're talking minimum investments of $250,000 to $1 million or more. They charge outrageous fees. The famous 2 and 20 model means 2% annually plus 20% of any profits. If your hedge fund makes 10% returns in a year, you pay 2% management fee plus 20% of the 10% gain, which is 2% more, totaling 4% in fees. On a $100,000 investment, you pay $4,000 in fees while keeping $6,000 in gains. Why do people pay these insane fees? Because hedge funds promise they can make money even when the market crashes. They use complex strategies like short selling, leverage, and derivatives. The reality, most hedge funds don't justify their fees. After accounting for fees, many hedge funds underperform simple index funds over the long term. Hedge funds exist to make hedge fund managers rich, not investors rich. Here's what actually matters for you. For 95% of people reading this, the choice is simple: low-cost index funds or ETFs. Index funds if you want to invest regularly and never think about it. Perfect for automatic investing from your paycheck. ETFs if you want the flexibility to buy and sell during market hours, or you like having real-time control. Mutual funds if you enjoy paying higher fees for the privilege of underperforming the market. Spoiler alert, you don't. Hedge funds if you're already rich and want to gamble with money you can afford to lose. The brutal truth about fees. This is where most people get destroyed without realizing it. Let's say you invest $500 per month for 30 years. At 7% annual real returns, that's after accounting for inflation. With 0.1% fees, index fund, you end up with about $632,000. With 1% fees, mutual fund, you end up with about $502,000. That 0.9% difference in fees costs you $130,000 over 30 years. $130,000 for absolutely nothing except making fund managers richer. This is why the investment industry pushes mutual funds so hard. Those fees add up to billions in profits for them and over $100,000 in losses for you. So, what should you actually do? Stop overthinking it. Pick a low-cost index fund or ETF that tracks the total stock market or S&P 500. Invest consistently. Ignore the noise. Vanguard, Fidelity, and Schwab all offer excellent options with rock-bottom fees. Any of their total stock market index funds or ETFs will crush 90% of actively managed funds over time. But here's how most people screw this up. Even with simple advice, people find ways to sabotage their own success. I've watched smart people make stupid decisions that cost them thousands of dollars. Here are the biggest mistakes. Mistake number 1, chasing last year's winner. You've probably thought, this mutual fund returned 30% last year. I need to get in on that. Here's the problem. Last year's best performing fund is usually next year's disappointment. Fund performance is cyclical. What worked last year probably won't work this year. I've seen people jump from fund to fund, always buying after the big gains and selling after the losses. They end up buying high and selling low repeatedly. The reality, that 30% winner probably had terrible performance the previous 3 years. You're buying right when it's about to cool off. Mistake number 2, switching funds constantly. Some people treat their investment accounts like a video game, constantly switching between funds based on performance or news headlines. Every time you switch, you're potentially triggering taxes and definitely wasting time that could be spent actually building wealth. I know someone who changed funds 8 times in 2 years, always chasing better performance. His returns were worse than if he'd just picked one decent fund and left it alone. The math doesn't lie. Time in the market beats timing the market, but switching funds constantly means you get neither. Mistake number 3, trying to time the market with fund purchases. You've probably heard this. The market looks scary right now. I'll wait for it to drop more before I buy. This is how you miss out on years of growth while waiting for the perfect moment that never comes. Market crashes are actually the best times to buy, but they're when most people get scared and stop investing. The people who kept buying during 2008, 2020, and every other crash are the ones who got rich. Mistake number 4, Overthinking fund selection. I've watched people spend 6 months researching the perfect index fund while their money sits in a savings account earning 0.1%. Here's the truth. The difference between the top 5 index funds is negligible. You're arguing over 0.03% versus 0.05% fees while missing out on months of potential market growth. Just pick one and start investing. The biggest mistake is not starting at all. Mistake number 5, falling for marketing and ratings. You've probably heard somebody say this fund has a 5-star rating from Morningstar. Fund ratings are mostly backward-looking and don't predict future performance. A 5-star rating usually means the fund did well in the past, not that it will do well in the future. Fund companies spend millions on marketing to make their products sound special. Growth and Income Fund, Strategic Opportunities Fund, Dynamic Balanced Fund. It's all just fancy names for expensive mediocrity. Mistake number 6, not knowing what they actually own. Most people buy funds based on the name or marketing without understanding what's actually inside. They'll buy 3 different growth funds thinking they're diversified, but all 3 funds own the same companies. You end up paying 3 sets of fees for the same investments. Or worse, they buy a balanced fund thinking it's conservative, but it's actually 80% stocks and gets crushed during market crashes. The cost of these mistakes. Let me put this in perspective with real numbers. Smart investor picks one low-cost index fund, invests $500 per month consistently for 20 years at 7% real returns with 0.1% fees. Result, approximately $244,000. Mistake-prone investor switches funds frequently, missing market gains, stops investing during crashes, chases last year's winners, pays 1.5% fees on average. Actual returns, approximately 4% after fees and behavioral mistakes. Result, approximately $183,000. Same person, same income, $61,000 difference. That's the cost of making these common mistakes, and that's on top of the $130,000 you're already losing to high fees if you pick the wrong funds. Here's what actually works. The investment industry wants you to think this is complicated because complicated products generate higher fees. The truth is, investing successfully is boring. Buy one fund that owns hundreds of companies for you, keep costs low, stay invested for decades. That's it. That's the secret. Everything else is just marketing, designed to separate you from your money. Your job isn't to find the perfect investment. Your job is to avoid the terrible ones and let compound growth do the heavy lifting. The choice is simple. Keep it simple and get rich slowly, or chase complexity and stay broke forever.